Jim, why you believe gold will be at $15,000 and how soon you expect that?
I do believe that. I think the analysis supports that, and I'm happy to explain that. There are, and by the way, this will take several years, so the horizon for that is maybe 2025. Could be sooner, but 2025 is a reasonable estimate. And I base it on three things. Number one, um, there's no central bank in the world that wants a gold standard today. It sounds like there's some secret cabal of central banks. Let's go back to the gold standard. That's not happening. They don't want it, but they may have no choice. It may be the case that there's a loss of confidence in command money or so-called fiat money, paper money, whatever you want to call it, and they have to do something to restore confidence. So it's not a question of do they want it; it's a question of do they have to do it? Is it out of necessity? Well, if you do, it begs the question, well, what price would you go back to? What would the US dollar price of gold be if you were going to have a gold standard? Again, I'm not saying they want it. I'm saying they may have to go to it out of necessity because of a more general loss of confidence in central bank currencies. Well, you can make two mistakes. If you're going to have a gold standard, so the paper money is convertible into gold, et cetera, if you get the price too low, everyone's going to come buy your gold and you'll be out of gold very quickly. It'll be a repeat of what was happening internationally in 1971. If you get the price too high, you'll have the opposite problem. Everyone will sell your gold and say, give me the money. And the first, where the price is too low, is actually inflationary. And the other one where the price is too high is deflationary, and they're both bad. So you have to get to the right price, the right exchange rate. It's just like any other cross exchange rate between gold and dollars, so that it's not inflationary on the one hand, not deflationary on the other. Well, how do you do that? Well, it's a pretty simple math problem. You basically take the gold supply, which in the case of the United States is about 8,100 metric tons, and then you take the money supply, which varies, but we can estimate that. By the way, you'd have to do this globally. You'd have to get, Japan and Australia and Canada and Europe and other major economies to join you to prevent arbitrage. But basically, the numbers are a global M1 is about $30 trillion. It varies, it's growing, but it's about $30 trillion. The global gold supply is about 35,000 metric tons, give or take. So you just do the math. What is the price per ounce if you have, pardon me, if you have $30 trillion of money and 35,000 metric tons of gold? So you have to make one other assumption, which is what ratio of gold to money do you want? Well, the answer, 40% historically has been enough. The Austrians say it's got to be 100% or nothing. That's not true. A 40% backing is pretty strong. That'll work. So if you have a $30 trillion of M1, 40% of that is 12 trillion. If you need $12 trillion worth of gold and you have 35,000 metric tons, what's the price? Well, it comes out around $15,000 an ounce. So again, that's not some number I pulled out of the air just to attract attention. I mean, I don't need that, and I wouldn't work that way anyway. It's a very straightforward math problem, but that is the implied non-deflationary price of gold. That is the price that gold would have to be to avoid inflation or deflation on the gold standard. So that's one method. There's another method, completely different, which interestingly ends up in the same place, which is it's more of a technical method. So we've had two great bull markets in gold starting in 1971. Prior to 1971, you didn't have bull or bear markets in gold because we were on a gold standard. It was a fixed price. It didn't go up or down. It was fixed. Yeah, there were adjustments during the Great Depression. The dollar was devalued, but and then prior to the 1870s, gold was money. People walked around with 8-gram coins. The British sovereign was the classic. We go all the way back to the Roman Empire earlier. There was no question of exchange rates. Gold was money. But beginning with say the 20th century, we've had these various gold standards. They weren't broken completely until 1971. So that's the where you begin your analysis of bull and bear markets. So the first great bull market was 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That's about a 2,000% increase. Then you had a long bear market from 1980 to 1999, slow, gradual, but just kind of ground its way down. Then beginning in 1999, when gold was $250 an ounce, you had the second great bull market, which lasted for 12 years, from 1999 to 2011, and gold went up almost 700% from $250 an ounce to $1,900 an ounce. And then you had another bear market from 2011 to 2015. The third great bull market started, we know the exact date, December 16th, 2015. It's when Janet Yellen's liftoff took place, ironically, and gold was $1,050 an ounce. Today, it's up over 80%. As you mentioned, it's 1,800, $30 or $40 an ounce. It bounces around a little bit. So in this new bull market, somewhere around close to $15,000 an ounce either way. The third thing I would mention, Greg, and this is the part that people just don't understand. Let's say gold's, let's just say $2,000 an ounce. It's not there. It's 1830 or so, but just take $2,000 an ounce for a round number. And gold was there last summer. Well, to go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a big lift. You really got to go up a lot. But to go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. It's the same $1,000. If you have an ounce of gold, you made $1,000 either way, and good for you. It's the same $1,000. It's real money, but the percentage increase gets smaller as the absolute value gets larger. So yeah, 2,000 to 3,000 is a long haul. 3,000 to 4,000 is a long haul. That's a 33% increase. But by the time you get to 10,000, it's only a 10% increase to get to 11. Then it's only a 9% increase to get to 12. And 14 to 15 is only a 7% increase. That's almost like 1 week's volatility. In other words, at the end, you start bang, 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 $1,000 an ounce in less than a month, or maybe even just a couple of weeks. So it starts out slowly, but happens very quickly at the end. So whether you're looking at central bank monetary policy, historical bull markets, or simple math, you get to $15,000 very easily.